Good morning, everyone, and thank you very much for joining me. This is the morning market review. It is Thursday. It is the 30th of November. My name is Russell Shaw, and I'm a senior market specialist at FXCM. What I'd like to do is just highlight my email address, rshaw@fxcm.com. If you need to get hold of me, that's the email address to use. There has been a few that have been sent through. Just wanted to say to Kim that I have forwarded the previous email on just for further information there. So we'll just see what kind of answer compliance gives. But good morning to you, Kim. Good morning, Michael. Welcome, as always. Hello, James. Good morning, Raj. It is a pleasure to have you on the webinar. Thank you, everyone, for signing in this morning. Much appreciated. All right, I'm just keeping this high risk investment warning on for a few moments. Hey, Anna, pleasure to have you on the webinar as always. Hello, Richard. Good day to you. Welcome. All right, let's bring up our market commentaries disclaimer. Let's take a look at that. I'll keep that on screen for a few moments as well. And just finally, our references, which would be MarketScope 2.0 and TradingView.com. We're going to go straight through to TradingView and, of course, straight through to the real rate. And again, highlighting what we've discussed before, but we'll do this day by day until they, and we'll do it day by day and monitor the changes as they happen. So everyone is aware that there's this head and shoulders top on the real rate. I'm still waiting for it to complete. I don't know if it's going to complete. We've got Fed Chair Powell speaking tomorrow. I think that's going to have an influence. And the key question, and I don't have an answer for this, but the key question is, do we carry on moving down? Do we carry on moving down? And if we do, we've got to understand why are we moving down. There's two scenarios here as far as I tell just off the top of my head, and they're very different scenarios with different ramifications. The first is that there's disinflation. In other words, we're moving towards that 2% target. That is, I think, constructive. I think if that's the reason that we are seeing lower real rates, that probably is a tailwind for the risk market. That's a tailwind for the risk market. Where it gets a little bit more complex, and again, we're going to have to wait and see as the data becomes available here. If the real rate's coming down, not because of disinflation, but because of economic weakness, because of recession, that's a different scenario. And I feel that's going to be a much more complex scenario for us to make our way through to pick sort of trading opportunities. If we start seeing a slowdown in data, there has to be a decline in rates, but it has very different ramifications. Okay, so we have to start introducing that theme now. It's not a theme that we've been talking about too often because I don't think it's been valid, but I think we are getting to that stage where we're going to have to monitor that. Now, so the first question, are we going to move down? And if we're going to move down, what are the reasons that we're moving down? Second question is, are we just move sideways? I don't think we're going to move much higher. We've got this top pattern in, okay? I think this top pattern either competes or it morphs into some sort of sideways consolidation. Of course, we'll keep monitoring, but we'll carry on using that as a compass, so to speak, of where we want to be in terms of our market positioning. Now, what we can do here is just again take a look at how the US dollar is doing, because when we analyze the US dollar, we're actually doing multiple analysis at the same time, because if the dollar is showing weakness or if the dollar is showing strength, well then that automatically is going to give you a clue to what's happening on the majors, right? So always important to take a look at the US dollar. Let's go ahead, bring up the US dollar underneath. Okay, and we can see there's a little bit of strength coming into the US dollar, a tiny bit. When I say a tiny bit of strength, just 2 candles of blue, and we've got this blue real rate, so the real rate moving up and the dollar moving up. I think that makes a certain amount of sense in terms of our indicators. I'm going to come back to this chart. Let's just go through to the US dollar on our main market scope now. So let's just bring up the US dollar. I want to also come back and just discuss very briefly this gold chart, just in more of a theoretical discussion, but we'll do that after the dollar. I'm just going to write it down here. All right, let's go through to this chart here. And, there is by and large weakness in the greenback. We've seen it now for a number of trading sessions. It's below that 30-week moving average. Then we use that 30-week moving average as a filter. How do we use it as a filter? Well, what is the direction of the moving average? Well, the direction's down. So there's sort of an added confirmation of downside momentum. Then with the RSI, I've started using trend lines on the RSI just to look for trend line breaks. So there's a few ways that I'm looking at the RSI now. The first way is consistent with the way we've always been looking at it. Are we on the bullish side of 50, or are we on the bearish side of 50? Well, we're on the bearish side of 50. On the bearish side of 50. Then the other way is to look at trend line breaks on the RSI. So I was reading. I went back to old notes and I was just going through the RSI and the notes had the trend line breaks. They said the trend line breaks of the notes said that the trend line breaks tend to be secondary signals, and you want to get a primary signal off some sort of trend following indicator. Okay. However that may be, we'll test it out. Okay. But the point is, we've got the RSI dipping below the upsloping green trend line. If we'd use that as a secondary, well then the primary would be here. The trend following indicator has turned down. Okay, but let's just go through to the daily chart now, because we did say that there is some support coming in for the greenback, and we're still very much in zone 3. Okay, but this has been one of the nicest trends to be following, one of the nicest trends to be trading for quite some time. It's been very orderly. The lower peaks followed by the lower troughs, followed by the lower peaks, followed by the lower troughs have been very ordered here. I don't know how long it's going to carry on for, but what we can do is we can just put in the next lower trough. Okay. And now that we've got this lower trough in, actually, I'll be honest with you, it's not quite a lower trough yet. It's a lower trough question mark, because we don't have a reference candle reversal here. So nevertheless, we'll put it the lower trough question mark. If it does turn out to be a lower trough, then the next move, if the order, if the sort of, I'm not quite sure the correct word, it retains its order, then we should see the next lower peak here, right? And if we get the next lower peak, then we could potentially try get into the next impulse downwards. Again, this is speculation, it's conjecture. I don't know if that's the way it's going to unfold. What I can say is that the dollar has been very, very good instrument to just apply a peak and trough analysis to. The fact that we have this head and shoulders top to it, and if we carry on towards the neckline, I would suspect that the order in the US dollar continues. And if that order in the US dollar continues, then I think that the order ripples out to the other majors, to the Euro, Cable, Aussie, Loonie, right? So I think the real rate, sort of using that as our anchor, still very much valid. Now, just to introduce some complexities into the analysis, truth be told, they've been introduced before, but where we've got to consider complexities is, okay, are we going to get this lower peak? Are we going to get this correction? And I think a large part of this actually is based on the risk market. We go through to the S&P 500 here. We go through to the S&P 500. And we've got the S&P 500 now correcting. Okay, so the fact that it's fallen below the 80 line, I think, is healthy. The overbought condition here. What has the overbought condition here actually done? It's put a cap. It's put a ceiling on the S&P 500. So we had a really nice S&P 500 move up, hitting that overbought, and then bang, we got this this cap on it. The fact that we've now moved back under the 80 area, I think is good, because it's potentially setting us up for that Santa Claus rally. It's potentially setting us up for that Santa Claus rally. We want to see the real rate still come down. What's the big fundamental catalyst there? What's the news item that we are going to have to wait for? Tomorrow, it's the Jerome Powell is going to be talking. I'll mention more about it tomorrow, but the idea here is very important. Let's just take a look at a top-down approach for the S&P 500. Let's just keep with our methodology. Okay, so I like the fact that we're above that 30-week moving average. I like the fact that that 30-week moving average is moving up, and I like that the RSI is above 50. I think that this type of chart pattern bodes well as we move into 2024. How 2024 turns out is a mystery, is a conundrum. But I'm busy working on an article now, and of course nobody knows the future. We can only make sort of forecasts and then see if the market cooperates with those forecasts or not. But I think going into 2022, it looks okay. If we go through to the monthly chart here. The monthly chart, well, we've got angle and separation in the EMAs, and we've got the RSI above 50. As long as we maintain that, I think that we have a good 2024. I think then we have a good 2024. What tends to happen is that we drop below 50 when we go into bear markets. Okay, well, we're above 50 now, so I think it's looking pretty good. But the big deal here for me is that the RSI is normalized, and because the RSI is normalized, I think that we may get that order in the US dollar still playing itself out. If we get, so going just back to the US dollar, if we get the order in that US dollar playing out, well, then potentially this lower peak coming in here. And if we have some sort of lower peak here, potentially setting us up for some of the other instruments. Let's just take a look at Euro and Cable. All right, so Euro above the 30-week exponential moving average. Apply that filter. The 30-week moving average is turned up. That's positive. RSI above 50, positive. Go to the daily chart. We're in zone 1. Not only are we in zone 1, there's some red here, which potentially means a pullback in an uptrend. A dip in an uptrend. Well, if it's a dip in an uptrend, there's hopefully an opportunity here, but we don't want to make predictions. We want to take reactions. So what we're going to have to see, S1 looks like there's a big sell down here in in the euro, and we just want to see if that's going to hold at that S1 support. Okay, is it going to hold at that S1 support? If it holds at the S1 support, there has to be a positive crossover in the EMAs. There has to be a crossover in the stochastic, and then we want to get the stochastic into that upper quintile. Okay, into that upper quintile. So we want to just keep an eye on that. The push down in the euro seems to be, there was some news that came out of France. Just taking a look, retail sales. Let's just go through to the 15-minute here, because it came out at 45 minutes past the hour. So retail sales have missed in Switzerland at 30 minutes past the hour, and then French consumer spending, preliminary CPI, preliminary GDP have all missed. So potentially that's what we're seeing here, but we want to apply. So I think that the data in of itself here has seen some sort of reaction, but the primary trend here, based on, I would imagine, that head and shoulders pattern in the real rate, and if that real rate is still looking to break down in the neckline, then this S1 is looking like it's potential support, and if we get a dip in the uptrend here, there's a potential opportunity. Let's just take a look at cable. Okay, so it's above that 30-week exponential moving average, a 30-week exponential moving average moving up, positive. RSI above 50, positive. Okay, go through to the daily chart. We are in zone 1. Okay, we've moved out of overbought territory. Okay, the central pivot's looking quite good in terms of support. All right, we don't want to predict, we want to react. Do we get a angle and separation in the EMA? Do we get a positive cross here in the stochastic? If we do, and we make our way through to the upper quintile, potentially we get a nice swing going. All right, I just want to take a look at the gold chart. This is more a theoretical chart more than anything. Just want to bring that up. And then I think we'll just take a look at DAX. I wanted to show you guys, I think this is a really good example of a trend. Let's just take this 2 out, take the 1 out. Just take a look at the higher trough, higher peak. Just look at, this is kind of a beautiful 1, 2, 2, 3. Here's the next impulse move, 1, 2. Even if we get a pullback here, you know, sort of to the 2000 level, that carries on. So just like the dollar is unfolding in on the daily chart in terms of a nice sort of order, it looks to me as if gold is exuding an order as well. We'll carry on monitoring it. We'll carry on monitoring, but this is a really nice looking chart, and it's one that we've been looking at for quite a long time as well. And then I just think the final chart that we should look at is the DAX. Let's just see how DAX is looking. It should have opened now. We're about 1 minute past the hour. We're above that 30-week exponential moving average. That 30-week exponential moving average has turned up. Take a look at the RSI. It's above 50, positive. Let's go through to the daily chart. All right. Here we've got the daily chart. This is I think a little more complex than the S&P. So we did briefly break below 80. We did sort of see a little bit of a pullback, and then we